All right, we are live. Yes. So today we're going to talk about who should pay quarterly taxes, right? I'm pretty sure you've asked yourself that a lot. And if you are responsible for paying estimated quarterly taxes, how much should you pay? Like, how do you figure that out? And how should you make the actual payment? Well, have no fear because in today's episode, I will break down everything you must know about paying estimated quarterly taxes as a business owner. Stay tuned. Welcome to Say Yes to Profits. Here at Say Yes to Profits, we help consultants build $1 million firms while tripling their cash flow and profits without stress, struggle, or burnout. Now, our goal is to make you smile when you log into your bank account because you have more money, more profits, and you're paying less taxes. So subscribe, follow, and listen up. And as a result, we will make it rain money in your business. Now join me on the path to say yes to profits. Hi, everyone. I'm super excited that you're joining me today. This episode is so important as a business owner. Now, directly from the IRS, taxes must be paid by everyone that earns or receives income throughout the year. Yes, everyone. The IRS wants their money. Taxes can either be paid to the IRS, void withholdings, or estimated taxes. And here's the thing. If you are a business owner, there is a 90% chance that you must make estimated tax payments. You may be charged a penalty if you don't pay enough tax throughout the year through withholdings or estimated tax payments. Again, the IRS wants their money. You also may be charged a penalty if your estimated tax payments are late, even if you are due a refund. So let's deep dive into everything you need to know regarding estimated quarterly tax payments for a business owner. Now, by the way, be sure to click the like, subscribe, and share button right now. Also, leave your questions and comments below. And if you're joining us live, I will answer your questions or address your comments at the end of today's live. If you're watching a replay, still leave your questions and comments and I'll answer those as well. So let's go ahead and get started. First thing, who should pay estimated quarterly taxes? Anyone who is a freelancer, self-employed, or a business owner generating profit within their business has to pay estimated quarterly taxes. If you do not have taxes withheld on your paycheck, you should also pay estimated quarterly taxes. If you are a business owner who expects to owe $1,000 or more in taxes, you should also pay estimated quarterly taxes. Even if you receive a salary, it is still very possible to have to pay estimated taxes depending on your projected tax liabilities. Okay? If taxes are withheld from your paycheck, in most cases, you will not have to pay estimated quarterly taxes. I hope that you're clear on that, all right? So the next thing, what is needed to calculate your estimated quarterly taxes? There are 5 things you need to know to calculate estimated quarterly taxes. Number 1, your expected adjusted gross income, also known as AGI. I'm pretty sure you've heard of that before. Number 2, your taxable income. Number 3, your taxes. Number 4, deductions. And number 5, credits for the year. Okay? Now, when determining these items that I just mentioned, a good reference will be to use information from your previous year's tax return or your financials. Also, you can use a Form 1040 ES worksheet to calculate your taxes. And I'm going to show that form on the screen here. Now, to complete this form, you must first determine your adjusted gross income for the year. Okay? To determine your adjusted gross income, calculate your income from your wages, investment, business income, and any other income you expect to receive for the year. And later on, if you stay with me now, watch the entire video, I'm going to go over that with an example. Okay? Once you have identified your AGI, you need to project your total deductions and your taxable income for the year. So let's also break that down. Okay. Your taxable income is the amount of income subject to taxes. A tax deduction or tax write-off is an expense that can be deducted from your taxable income. More about your tax write-offs in just a moment. Now, for businesses, as you can see on the screen, if you take your revenue minus your expenses, aka your deductions, that will give you your taxable income amount. Now, here's what you have to understand. A tax deduction allows you to lower your taxable income, and as a result, you pay less taxes. I hope you all are with me so far. Now, let's discuss tax deduction. I'm going over all of this because I want to make sure that you're perfectly clear. Now, there are two types of deductions for business owners. You have your cost of goods sold and expenses. Your cost of goods sold are the out-of-pocket costs to create a product or provide a service in business. And your expenses are the daily costs to operate the business, not including your cost of goods sold. Both deduction types can reduce your taxable income. All right. Examples of COGS, cost of goods sold, is if you sell books, t-shirts, and websites. Those raw materials and things that you have to buy are your cost of goods or services sold. Examples of expenses includes advertising, bank fees, interest, legal fees, accounting fees. Hello, say yes to profits. They should be your accountant. Shameless plug. Insurance, office supplies, property taxes, rent, and utilities, and more. Okay? So those are your tax deductions. I hope that you all are with me so far. Definitely leave your questions and comments, and I will address them at the end. All right. So now we're going to move on. How to actually determine your estimated tax payments. Once you have your taxable income, you will use the IRS tax rate schedule to estimate your yearly taxes. I'm going to share that on the screen now, okay? The IRS tax rate schedule shows the income tax percentage and tax bracket for each income level. It will also help you determine your tax liability for the year. So this is highly important, and this is something you must have as well. Okay? Now, once you have this information, you must also include a self-employment tax rate of 15.3% of your first $147,000. Okay? Of the earned net income if you are a sole proprietor or partnership. So let me make sure I make that clear. So you earn 147,000. So the next 147,000, you're going to add 15.3% to that. All right. So I want to make that perfectly clear. Now, the net income for your business is when you take your total yearly business revenue and subtract your expenses, aka your deductions that I went over earlier. Now, the total will either be a net income or net profit if you earn more revenue than you spent, or a net loss, meaning you spent more revenue than you actually earned. All right. Now, what I'm going to do now is share my screen, and I'm going to break all of this down for you so that you have a clear understanding of everything. So give me just a moment to share my screen. And I'm going to show you everything. Okay. So here is an example of how to calculate your quarterly or yearly taxes for your business. So let's just say you are a business owner, right? And your wages were zero and your interest, you had $20 in interest, okay? And let's say your business total income was $350,000, right? So that means your total adjusted income is what you see here, $350,020. Okay, you all with me so far? So now we go to the business deductions. Remember, we went over that earlier on what your business deductions are. But let's just say, for the purpose of the example, we're going to say your business deductions were $200,000. Okay. We're also going to say that your total itemized deductions, meaning all of the other things that you can deduct on your personal side, was $15,000. Okay, let's just say. So that means your total taxable income for the purpose of this example is $135,000. All right. Now you have to go to that tax rate sheet and figure out what is your tax rate amount. So the way that you use this tax rate sheet is that you first have to determine your status. Are you single? Are you head of household? Are you married filing jointly? A qualified widow? Are you married filing separately? You determine that first. And then based on that amount, you go to the chart and you say your total taxable income is $135,020, right? And we're going to say that you are single. Okay. So for the purpose of this example, if we see that single is $15,213.50 plus 24%, we take that number, determine what it is, and we have to add it in here. So we're just going to say 16,500. All right. For self-employment taxes, again, the second 147,000, you have to add 15.3% to your taxable amount. Let me know if you have any questions. That's going to be $20,000. So for the $20,658.06. So for the purpose of this example, your total yearly estimated taxes will be $37,158.06. Once you divide that by 4, this will tell you your quarterly estimated taxes, $9,289.52. This is the amount that you would pay to the IRS. Okay? Now, keep in mind that the IRS is well aware that this is an estimate. So don't be stressed out if it's a little off, because they're aware that it is an estimate. All right. So your number may not be 100% accurate, but use the example that I just gave you to get a really good estimate. So the next part, you're probably wondering, okay, I got all of that together. How do I pay estimated tax payments? Great question. You can pay your estimated tax payments online at irs.gov/payments. You can also pay by phone with a check or a money order. Now, here's the thing. If you pay by check or money order, you want to make sure that it is paid to the United States Treasurer and that you mail it to the correct address. You know, the IRS have a couple of different addresses. So you can find out what address you are to mail this to by going to the irs.gov/payment website. All right. So my next thing, how to avoid estimated tax underpayment. To avoid the estimated tax underpayment, you should pay at least 10% more than your previous year's tax liability to the IRS over the 4 quarters. Okay. In the IRS eyes, when you do this, you demonstrate a responsible taxpayer and you are operating or seen as an operating in good faith when you do this. All right. So hopefully I've answered all of your questions regarding estimated tax payment. Okay, let me check the comments and see. So we do have a question. Is there a grace period? So when you're making your estimated quarterly tax payment, you want to make those on time. All right. When you file your taxes, you can actually contact the IRS and you can set up a tax payment schedule with them, but you definitely want to make your tax payment on time. So thank you so much for your question. Let me know if you have any other questions or comments, and I'll definitely answer those. Also, make sure that you hit the like and subscribe button right now and join me every single week. Okay? This is Octavia Conner. Until next time, everyone, say yes to profits. Toodles.